dodge, quite frankly. Here's another one out of PIMCO. See no value in treasuries, high value mortgages, and swaps are attractive. High value mortgages and swaps are attractive. Okay, they're talking it up. And you better believe that traders they're watching this stuff, they're looking at CNBC, they're watching Bloomberg, and this stuff will affect the market. Here's the last one. This one is out of the UK. Today's joint action is a clear signal central banks are ready to do whatever is necessary. Now, if you're a market operator and you hear this over and over, that the central banks are willing to do whatever's necessary, you're going to go in there and be very active. You're going to want to buy equities. You're going to want to, in some cases, well, that depends on what happens to the yield curve, but maybe short treasuries. In other words, the bonds, notes, maybe even sell off some corporate bonds. Why? Because you're going to make more of a return somewhere else. Now we're getting really into the heart of what goes on. So you get this churn. They're churning the market, getting people excited about things in general, talking up whatever they can possibly talk up, make up everything else that they can't. And then, one more, no. Okay, I thought I had one more. And then, hopefully, the blow-off market action, where you get the individual sucked into the market, whichever direction that may be, and then you have a massive, prolonged move. So, let's look at a daily. I'll just kind of run through this fairly quickly. I'm not going to speculate a whole lot about where the dollar may go or what I think might happen. What I do want, however, is to focus on the realities of price action. And the realities of short-term price action is a very clear downtrend. Okay, so midterm trend really at this point is down, even though long-term trend is still up. So we're getting basically this pennant-ish kind of pattern. You can see there would be the pole. Here would be the top of the pennant. Here would be the bottom of the pennant. This is very typical of market kind of action coming into support. You can see in October the market built what's called in some cases a high-level consolidation. And if you remember, I was talking about this back when this thing broke out, that you're probably going to see the market push back up, form a pennant pattern right back into support. Given the size of this bad boy, let's shoot some targets. There is roughly the open of the pennant, 800 pips, let's call it. So that's pegging on a down move down under 95, 195. On an up move, putting the thing above 219. That's the projected move based on the opening of the pennant. So you take, So you take the opening of the pennant from there. You have to kind of go back a little bit. From there to there, you see. So you take that distance and you project that to the top and the bottom. Now, with the Dallas system, do we necessarily care where the market's going? Not at all. At this point, the market volatility did get us in here on the low and then right back out. But that, let me tell you, it was said best by one of the turtles. I think his name is Curtis Faith. And he said, the more prolonged and vicious the consolidation, the more pronounced and profitable the trend. And this is my part, the hard part is sticking with it long enough to make any money. So we've got to kind of sit out these whipsaws, especially on the pound. The reason why I'm spending so much time talking about the background is you've got to realize the markets have changed. I mean, I would not be surprised if we started hearing rumors of massive bank failures. Not in terms of numbers, but I mean, not in terms of numbers of banks, but in amounts of money. I mean, listen, Northern Rock over in the UK was a 100 billion pound bank, and it failed. The Bank of England had to step in and rescue the bank, and now it's on the chopping block essentially for pennies. The stock was down, I think, some 80%.